Risks and challenges of global ETF investing. Global ETF investing has many of the same risks as investing in domestic funds, such as market volatility, but it also brings many unique challenges to keep in mind. One is that you will likely know less about another country's market and its operation. If you're an American investor, you interact with American business daily, follow American news, and understand the opportunities and risks each business and industry faces. When investing in another country, you're less familiar with its markets, meaning you'll have to spend far more time researching investment options. You'll also face regulatory risk. Sometimes, your government blocks trade or investing in foreign country stocks. That country might also impose regulations that affect the value of your investments. Inadequate regulations in the foreign market could mean a greater chance of fraud that affects your investment. Currency risk is also a concern. If the dollar gets stronger or the value of the other country's currency falls, your investment could lose value unless the fund uses hedging strategies. To limit these risks, it's important to build a diverse portfolio that doesn't focus too heavily on a specific country's stocks, and to spend time researching potential investments before you commit. Tax considerations for global ETF investors. When investing outside the U.S., taxes can be complicated. The U.S. collects taxes on your profits from foreign investments. However, every country has unique tax laws, so you'll have to deal with tax laws both in the U.S. and abroad. What are other ways to invest internationally? Investors who want to get exposure to global markets have many options other than ETF. For example, investors could trade American depository receipts, which are a way for foreign companies to access the American market, buy foreign shares over the counter, or even trade directly on a foreign stock market. Emerging markets and frontier markets are both names for what are considered smaller, less developed countries. Generally, emerging markets are those considered less economically developed, such as India, Mexico, or Saudi Arabia. Frontier markets are considered even less developed, and thus might pose more risk. BlackRock is the largest ETF provider globally, with about 425 ETF offered and more than $3 trillion under management. Global ETF investments are exposed to currency fluctuations because they typically use local currency. If that currency's value changes compared with the dollar, the value of that fund in dollar terms will also change. Some funds use hedging techniques to limit this risk. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.